Before we begin, a quick and important disclaimer. I am not a licensed financial advisor, and this presentation is for educational and informational purposes only. The content of this video should not be considered financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Always do your own research and consider consulting with a qualified professional before making any investment decisions. Your financial situation is unique, and any choices you make are your own responsibility. Okay, let's get into it. Picture two people, let's call them Jessica and David. They're both in their late 20s, they both have a steady job, and they've both managed to save up their first $5,000 to invest. They're excited. They're ready to start building wealth. But this is where their stories take a dramatic turn. Jessica dives headfirst into the world of stock picking. She's on Reddit, she's watching the news, she's looking for that one hot tip, that one company that's about to explode. She hears about a new tech startup with a revolutionary product. The hype is massive. She puts all $5,000 into it. For a week, it's a rocket ship. Her account is up 20%. She feels like a genius. Then the company misses an earnings target. A competitor announces a better product. The stock plummets. In a month, her $5,000 is worth less than $2,000. She panics and sells, locking in a massive loss. Now let's look at David. David hears the same noise, sees the same hype, but he chooses a different path. He takes his $5,000 and buys into something called a mutual fund. He doesn't even know the names of all the companies inside it. It's kind of boring. His account doesn't shoot up 20% in a week. In fact, it barely seems to move. It just plods along, a little up one day, a little down the next. He basically forgets about it. Fast forward 10 years. Jessica, after getting burned, became scared of investing. She kept her money in a savings account, where it was eaten away by inflation. David, on the other hand, kept adding a little bit to his boring investment every single month. He never had a thrilling story to tell at parties, but when he checked his account after a decade, his initial $5,000, plus his small, consistent contributions, had quietly and steadily grown into a substantial six-figure sum. The difference between financial failure and financial success for Jessica and David wasn't luck. It wasn't genius. It was understanding a single fundamental choice that every single new investor in the United States has to make. And that choice is the entire reason you are watching this video. It's the battle between individual stocks and mutual funds. And here's the brutal truth. Most new investors get this wrong. They jump in based on emotion, based on a friend's tip, or based on some headline they saw, without ever understanding the profound difference between the vehicles they are using to invest their hard-earned money. Getting this one decision right is more important than picking the perfect stock. It's more important than timing the market. It is the foundation upon which your entire financial future will be built. So, my promise to you in this video is simple. We are going to end the confusion, right here, right now. We are going to pull back the curtain and demystify these two giants of the investing world. By the end of this, you will understand with crystal clarity what a stock is, what a mutual fund is, how they are fundamentally different, and most importantly, you'll have the framework to decide which path is right for you, for your goals, and for your personality. This isn't about telling you what to do. It's about giving you the knowledge to make that decision with unshakable confidence. To do that, we have to start at the very beginning. Forget the complicated charts and the confusing jargon for a second. Let's talk about what the stock market even is. When you hear that phrase, you probably picture a bunch of numbers flashing on a screen, or people in suits yelling on a trading floor in New York City. But at its core, it's much simpler. The stock market is just a giant marketplace where you can buy and sell tiny pieces of ownership in real, living, breathing businesses. That's it. Companies like Apple, which makes your iPhone, Nike, which makes your sneakers, Starbucks, which makes your morning coffee. These are all businesses that need money to grow, to invent new products, to hire people, and to build new stores. One of the ways they raise that money is by selling off tiny little slices of the company to the public. And that brings us to player number one in our showdown, the individual stock. A stock is one of those tiny slices. When you buy one share of Apple stock, you are not just buying a digital receipt. You are literally becoming a part owner of Apple. A very, very, very small part owner, but an owner nonetheless. If Apple does well, invents the next must-have gadget, and its profits soar, the value of your tiny slice of the company goes up. You can then sell that slice to someone else for more than you paid for it. That's the dream. You buy a slice of a small unknown pizza shop for $1. It grows into a massive global chain, and now your slice is worth $1,000. This is the incredible appeal of buying individual stocks. It offers the potential for explosive, life-changing returns. If you had invested just $1,000 in Amazon back in 1997, it would be worth millions of dollars today. This is what Jessica was chasing. The thrill of the hunt, the satisfaction of being right, the intoxicating possibility of picking the one winner that changes everything. When you buy an individual stock, you are making a concentrated bet. You are saying, I believe in this company. I believe in its leadership, its products, and its future, more than all the others. The potential reward is enormous. But for every Amazon, there are thousands of companies that fail. Companies that were once darlings of Wall Street now don't even exist. Pets.com, Blockbuster, Enron. The risk is just as enormous as the potential reward. When you put all your money into one stock, you are tying your entire financial fate to the success or failure of a single business. If they make a bad decision, if their CEO has a scandal, if a competitor outsmarts them, the value of your slice can get wiped out just like Jessica's did. Picking individual stocks isn't just about analyzing numbers. It's a high-stakes game of research, conviction, and emotional fortitude. Now let's turn to player number 2, the mutual fund. If buying a stock is like buying a single specific ingredient, say a perfect ripe tomato, then buying a mutual fund is like buying a pre-made basket of groceries. You're not just getting the tomato. You're also getting lettuce, cucumbers, onions, carrots, and a bottle of dressing, all bundled together for one price. A mutual fund is a company that pulls together money from thousands of investors, people just like you and David, and uses that giant pile of cash to buy a whole bunch of different investments. Usually, that means buying stocks, but it can also include other things. So when you put your $5,000 into a mutual fund, you're not buying one tiny slice of one company. You are instantly buying hundreds or even thousands of microscopic slices of many different companies all at once. The fund is managed by a professional, a portfolio manager, whose full-time job is to decide which groceries go into the basket. They do the research, they pick the companies, and they manage the collection on behalf of everyone who invested. This immediately introduces the single biggest concept behind mutual funds: diversification. It's the oldest saying in investing: don't put all your eggs in one basket. That's exactly what a mutual fund does for you automatically. Think back to Jessica. She put all her eggs in one tech startup basket. When that basket dropped, all her eggs broke. Now think about David. His mutual fund probably owned a tiny piece of that same failed tech startup. But it also owned a tiny piece of Apple, a tiny piece of Nike, a tiny piece of a boring utility company, and hundreds of others. So when that one tech stock collapsed, it was just one broken egg among hundreds. The loss was tiny, barely a blip in his overall account, because the success of all the other companies in the basket cushioned the blow. This is the core appeal of the mutual fund. It's a vehicle built for safety and consistency through diversification. It's designed to capture the general upward trend of the entire market, rather than betting it all on one horse. It's the boring path David took. The trade-off is that you'll likely never get those explosive, life-changing returns from a single investment. Since you own a little bit of everything, you're never going to see your account go up 1,000% in a year because one company took off. But by the same token, you're also extremely unlikely to see it get wiped out. You're trading the potential for spectacular wins for protection against catastrophic losses. So we have our two contenders standing in opposite corners of the ring. In one corner, the individual stock, the sniper rifle. It's precise, high impact, and offers the potential for incredible rewards. But if you miss your shot, you're left with nothing. In the other corner, the mutual fund, the broad shield. It protects you from any single attack, allows you to advance steadily across the battlefield, but it lacks that single knockout power. One is a bet on a single company's brilliance. The other is a bet on the broad success of the entire economy. One demands your active participation, your research, your conviction. The other asks for your trust and your patience. One is the path of Jessica. The other is the path of David. The question is no longer just, what are they? The real question, the one that will define your journey as an investor, is which one is built for you. To answer that, we need to go deeper. We need to break down the key, practical differences between them piece by piece. Things like cost, control, complexity, and taxes. And the very first and perhaps most important difference we need to dissect is the concept of control versus convenience. Let's imagine for a moment you're not an investor. You're just hungry. You have two choices for dinner tonight. Option 1, you go to the grocery store. You walk every aisle, examining the produce, comparing brands of pasta, reading the labels on sauces. You decide you want to make a complex, multi-course meal from scratch. You select the perfect tomatoes, the freshest basil, the highest quality olive oil. You take it all home, you chop, you sauté, you season. You control every single ingredient, every step of the process. The final meal is exactly, precisely what you designed. This is buying individual stocks. You are the chef. Option 2, you go to a restaurant. You sit down, a professional chef has already designed the menu, sourced all the ingredients, and perfected the recipes. You don't pick the individual spices or the brand of flour. You just choose the type of meal you want, the Italian feast or the seafood platter. You trust the expert to handle the details. You get a delicious, well-balanced meal delivered to your table with almost no effort on your part. This is buying a mutual fund. You are the diner. This single analogy is the most powerful way to understand the fundamental trade-off between stocks and mutual funds. It is the trade-off between absolute control and incredible convenience. Let's stick with being the chef for a minute, the stock picker. When you buy a share of a company, say Apple or Nike or Ford, you are taking direct ownership of a tiny slice of that business. This gives you an immense amount of control. You decide which company to buy. You've done the research, you believe in their leadership, you like their products, you think their stock is undervalued. It's your call. You decide when to buy. You see the market dip and you think it's the perfect time to get in. You pull the trigger. You decide how much to buy. Maybe you just want to dip your toe in with one share, or maybe you want to make a big bet with 100 shares. And crucially, you decide when to sell. If the company's direction changes, if a scandal breaks, or if you simply think the stock has peaked, you can sell your shares in an instant. This is granular, hands-on control. It's like being in the kitchen and tasting the sauce as it simmers. A little more salt? You add it. A little too much garlic? You can try to fix it. You have the power to react in real time to new information. If a company you own, let's call it Innovate Corp, announces a revolutionary new product, you can immediately decide to buy more shares to double down on your winner. Conversely, if their biggest competitor releases something that makes Innovate Corp's product look obsolete, you can sell your entire position before the end of the day. You are at the helm of your own ship, steering it through the market's waters. But with great control comes great responsibility. Being the chef means you are responsible for everything. You have to do the research, and I don't just mean reading a few headlines. I mean digging into financial statements, understanding income reports, balance sheets, and cash flow. It means analyzing the competition, understanding the industry, and trying to forecast future growth. It's like learning the science of cooking. Understanding how heat, acid, and fat interact. Takes time, takes effort. And if you get it wrong, if you pick a company that goes bankrupt, that's on you. Your investment could go to zero. If you build a portfolio of stocks that are all in the same industry and that industry takes a nosedive, your entire meal is ruined. The responsibility for diversification, for risk management, for every single decision, rests squarely on your shoulders. Now let's go back to the restaurant, the mutual fund. When you invest in a mutual fund, you are not buying a slice of one company. You are buying a slice of a massive portfolio that might contain hundreds or even thousands of individual stocks, all pre-selected and managed for you by a professional fund manager and their team of analysts. You are handing over the keys to the kitchen. The convenience is undeniable. You don't have to spend your weekends poring over earnings reports. You don't have to stay up at night worrying about a single company's quarterly performance. The fund manager does all of that for you. Their full-time job is to be the expert chef. They have access to research and data that would be incredibly expensive or impossible for an individual investor to get. They make the buy and sell decisions. Your job is simply to choose the restaurant and the type of meal. For example, you might decide you want to invest in large, stable American companies. So you choose a large-cap U.S. equity fund. You give them your money, and they use it to buy a diversified basket of stocks like Apple, Microsoft, Amazon, Johnson & Johnson, and hundreds more. You get instant diversification. If one of those companies has a bad year, it's like one ingredient in a giant stew being slightly off. It's buffered by the dozens of other successful ingredients. The overall meal is likely still fine. The risk of a single bad stock pick wiping you out is virtually eliminated. This is an incredible benefit for new investors who are naturally worried about risk. But what did you give up to get that convenience and safety? You gave up control. You cannot call up the fund manager of your large cap fund and say, "Hey, I really don't like the look of Meta's new strategy. Can you sell all of their shares from the fund?" They would laugh you out of the room. You own the whole basket, not the individual items inside it. You can't customize the recipe. If the fund owns a company you personally disagree with ethically or financially, you have no choice but to own it as long as it's part of that fund. Your only real controls are at a much higher level. You can choose which fund to invest in. You can decide when to put more money into that fund, and you can decide when to sell your shares of the fund itself. But you have zero say over the day-to-day, stock-by-stock decisions. You're trusting the chef. You have to be comfortable with their cooking style, their philosophy, and their choices because you're eating whatever they decide to serve. You can't go into the kitchen and tell them how to do their job. So, the question you have to ask yourself is this: what kind of person are you right now as an investor? Are you the hands-on do-it-yourself type who wants to build something from the ground up, who enjoys the process of research and analysis, and who wants the ultimate power to craft a portfolio that is uniquely yours? Are you willing to accept the responsibility and the risk that comes with that control? If so, individual stocks might be your path. Or are you someone who values their time, who recognizes that they are not an expert, and who would rather outsource the complex, time-consuming work of stock selection and portfolio management to a professional? Are you looking for a simple, one-stop solution that provides instant diversification and peace of mind? If that sounds like you, a mutual fund is likely a much better fit. There is no right or wrong answer here. A world-class chef and a happy restaurant patron can both end up with a fantastic meal. They just took very different paths to get there. One chose control, the other chose convenience. And it's critical to understand that this isn't an all-or-nothing choice. Many sophisticated investors do both. They might cook for themselves during the week, managing a core portfolio of individual stocks they believe in, and then go out to a fancy restaurant on the weekend, using a specialized mutual fund to gain exposure to an area they're less familiar with, like emerging international markets. Understanding this core trade-off is the foundation for everything else, because this choice between being the chef and being the diner has huge implications for the next key difference we need to talk about. After all, cooking at home and eating at a restaurant don't just differ in the amount of control you have. They also have vastly different price tags. The convenience of that restaurant isn't free. You're paying for the chef's salary, the ingredients, the building's rent, the waiter's time. And that brings us directly to our next critical topic: the cost of investing. When you walk into that fancy restaurant, you don't get a bill itemizing the chef's hourly wage or the electricity used to cook your steak. You just get one price on the menu. The costs are bundled in. Investing works the same way. Both buying individual stocks and buying into a mutual fund have costs, but they are presented in completely different ways. And understanding this difference is one of the most important lessons in finance. It's the difference between a small leak in your boat and a gaping hole. Let's start with buying individual stocks, our grocery store model. The cost structure here is usually much more transparent. For decades, the primary cost was the commission. Every time you wanted to buy or sell a stock, you paid your broker a fee, a commission, to execute that trade for you. It could be $5, $10, even $20 per trade. If you were buying small amounts of stock, those commissions could eat you alive. But then the internet happened. Competition exploded. And today, for most major online brokerages in the United States, the commission to buy or sell a US stock is zero. Absolutely nothing. Now you're smart. You know there's no such thing as a free lunch. So how do these free trading platforms make money? One of the main ways is something called payment for order flow, or PFOF. It sounds complicated, but the concept is simple. Imagine you want to book a flight. You go to a travel agent and say, "Find me the best flight to Los Angeles." The agent comes back and says, "Here's one for $300. You say, "Great," and you buy it. What you might not know is that the airline secretly paid that travel agent a small kickback for sending you their way. You still got the $300 price you were quoted, but was it the absolute rock-bottom best price available across the entire market at that exact millisecond? Maybe not. Maybe there was another flight for $299.98. That's PFOF. Your broker takes your order to buy a stock, and instead of sending it directly to the New York Stock Exchange, they send it to a large trading firm, a market maker, who pays your broker a tiny fraction of a penny per share for the right to handle your trade. For your 100-share order of Apple, this is an invisible cost. We're talking pennies. But for the brokerage handling millions of trades a day, those pennies add up to a fortune. For the average retail investor, this is not something to lose sleep over. The main takeaway is this: the direct out-of-pocket cost to buy an individual stock is typically zero. You are the chef and you aren't sending yourself a bill. Now let's walk back into the mutual fund restaurant. Here, the costs are not a one-time transaction fee. They are ongoing, persistent, and often insidiously hidden. The single most important term you need to learn is the expense ratio. The expense ratio is the annual cost of owning the fund, expressed as a percentage of your total investment. This percentage is used to pay for everything: the professional fund manager's salary, their team of brilliant analysts, the marketing budget, the legal fees, the office rent, the coffee in the break room. It's all bundled into that one number. And here's the most critical part. You will never receive a bill for this fee. It doesn't show up as a line item on your statement. Instead, it is quietly, automatically, and relentlessly deducted from the fund's assets every single day. It's a slow, silent drain on your investment returns. Think of it like a tiny leak in a giant water tank. One drop a second doesn't seem like much, but leave it for a year, a decade, a lifetime, and you'll find the tank is half empty. Let me show you the devastating power of this silent fee with a real-world example. Let's say you have $10,000 to invest. You find two different mutual funds that both invest in the same types of large U.S. companies. They are virtually identical, and let's assume they both earn an average of 8% per year before fees. But there's one tiny difference. Fund A is a low-cost index fund with an expense ratio of just 0.1%. Fund B is an actively managed fund with a more typical expense ratio of 1%. A 1% fee. Sounds so small. Trivial even. What's the big deal? Well, let's run the numbers. After 1 year, your $10,000 in Fund A, earning 8% minus the 0.1% fee, would be worth about $10,790. In Fund B, earning 8% minus the 1% fee, it would be worth $10,700. A difference of $90. No big deal, right? Wrong. This is where the dark magic of compounding comes into play. That fee doesn't just cost you $90. It costs you the future growth that $90 would have generated forever. Let's fast forward 30 years. Your $10,000 investment in low-cost Fund A would have grown to approximately $95,000. Not bad. But what about Fund B with that tiny 1% fee? Your investment would only have grown to about $76,000. Let that sink in. A seemingly insignificant difference of 0.9% in annual fees has vaporized $19,000 of your money. That's a new car, a down payment on a house, a child's college education. It's a fortune, and it vanished into the fund company's pockets, not yours, all because of a fee that you never even saw. This is the single greatest wealth transfer from individual investors to Wall Street, and it happens every single day, silently, in millions of accounts. But wait, it gets worse. The expense ratio is just the main course on the cost menu. Some mutual funds also charge what are called loads. A front-end load is a sales commission you pay right when you buy the fund. You want to invest $10,000 in a fund with a 5% front-end load? Sorry, only $9,500 of your money actually gets invested. The other $500 goes straight to the salesperson or brokerage that sold it to you. It's like a cover charge just to get into the restaurant. Then there are back-end loads. A fee you pay when you sell your shares, usually within a certain number of years. It's like a mandatory exit fee. Thankfully, there are thousands of fantastic no-load funds available today. And for most investors, there is absolutely no reason to ever pay a sales load. So let's recap the cost. When you buy a stock, your primary direct cost is the commission, which today is often zero. You're doing the work yourself, so your ongoing labor costs are free. When you buy a mutual fund, you are paying an ongoing, annual expense ratio that silently eats away at your returns, year after year, with a compounding effect that can cost you tens or even hundreds of thousands of dollars over your lifetime. On top of that, you might even get hit with sales commissions or loads just for the privilege of investing. The difference in cost is astronomical. So this brings up a very important question. If the costs of mutual funds can be so devastatingly high, why do millions of people pour trillions and trillions of dollars into them? Why would anyone willingly walk into that expensive restaurant when the grocery store is right next door, basically giving away the food for free? The answer lies in a single powerful concept that every investor, new or old, must grapple with. A concept that can make or break your entire financial future. And that concept is risk. Risk isn't just a four-letter word that financial advisors throw around to scare you. It's the invisible force that governs every single investment. Think of it like the weather. You can't control it, but you can choose whether you go out in a t-shirt or a hurricane-proof jacket. Investing in a single stock is like betting your entire vacation on one perfect sunny day. Investing in a mutual fund is like preparing for a whole season of weather. You'll have some sunny days, some rainy days, but you're equipped to handle whatever comes. Let's make this real. Imagine a brand new, hyped-up company called Synapse Robotics. They've just unveiled a prototype for a home assistant robot that doesn't just play music. It cooks, it cleans, it even helps your kids with their homework. The CEO is a charismatic genius, a modern-day Edison, and every tech blogger on the planet is calling it the next big thing. The stock, ticker symbol SYNP, is available for $10 a share. You see the potential. You see the headlines. You think, if this thing takes off, I'm set for life. So you take $10,000, a significant chunk of your savings, and you buy 1,000 shares. For the first 6 months, you feel like a king. The company releases a slick marketing video, and the stock jumps from $10 to $30. Your $10,000 is now worth $30,000. You start daydreaming about paying off your mortgage, about that trip to Europe. You're checking the stock price 10 times a day. Your heart pounding with every little green tick upwards. This is the intoxicating allure of a single stock. You've hitched your wagon to a rocket ship, and the view is incredible. But then the unthinkable happens. A major news outlet publishes an exposé. It turns out the revolutionary AI in the robot was faked for the demo. The charismatic CEO is caught in a lie, forced to resign in disgrace. Panic erupts. The rocket ship doesn't just slow down. Its engines explode. The stock plummets from $30 to 5 to 1. And then within weeks it's delisted entirely. It's worthless. Your $30,000 dream, your original $10,000 investment, has vanished. It's gone. This isn't a scare tactic. This is the brutal reality of what's called unsystematic risk, or specific risk. It's the risk that is specific to a single company. The risk of a bad CEO, a failed product, a new competitor, a factory fire, a lawsuit. When you buy one stock, you are absorbing 100% of that company-specific risk. You are betting that this one company out of thousands will navigate every single potential disaster perfectly. You're betting on one high-wire walker crossing a canyon in a windstorm. It's thrilling if they make it, but it's a total loss if they fall. Now let's rewind. You have the same $10,000, but instead of buying Synapse Robotics, you buy shares in an S&P 500 index mutual fund. Remember our restaurant analogy? You're not just buying one chef's special. You're buying a tiny slice of the 500 largest, most successful restaurants in the country. Your $10,000 is now spread across giants like Apple, Microsoft, Amazon, Google, Johnson & Johnson. And yes, maybe even a tiny fraction is invested in a company like Synapse Robotics if it were big enough to make the index. The same news breaks. The Synapse Robotics scandal is everywhere. The stock collapses. What happens to your $10,000 in the mutual fund? Almost nothing. Because Synapse Robotics was just one of 500 companies in your portfolio. Its spectacular failure is just a tiny, barely noticeable blip on your overall investment. The 99.8% of your money invested in Apple, Microsoft, and all the others is still safe and sound, doing what those companies do best. The catastrophic fire in one house is a tragedy for the homeowner. But you own a piece of every house in the city. The city itself is fine. One walker falls, but the other 499 in the troop are still on the wire. This is the superpower of a mutual fund. Diversification. It is the single most powerful tool for slaying the dragon of company-specific risk. But this is where most people get a dangerously incomplete picture. They hear diversification and think it means risk-free. That is absolutely not true. While a mutual fund dramatically reduces that company-specific risk, it cannot save you from the other bigger kind of risk. The kind of risk that affects everyone. It's called systematic risk or market risk. Market risk is the hurricane that hits the entire city. It's a global recession, a financial crisis like in 2008, a worldwide pandemic, a major war. When these things happen, it doesn't matter if you own the best company or the worst company. The entire market tends to go down. Fear takes over and people sell everything. During the 2008 crisis, nearly every stock, from the strongest blue chip to the riskiest startup, took a massive hit. Your S&P 500 mutual fund would have gone down, too. Significantly. Because the risk wasn't about one company failing, it was about the entire economic system being under stress. So let's be crystal clear. Buying a single stock exposes you to both company-specific risk and market risk. You can lose everything because your one company fails, or you can lose a lot because the whole market crashes. Buying a mutual fund essentially eliminates the catastrophic threat of company-specific risk, but it still leaves you fully exposed to market risk. You've traded the risk of a sudden total wipeout for the risk of a gradual market-wide downturn. For most people, that is a fantastic trade. It's the difference between a lightning strike and a bad weather season. You can prepare for and survive a bad season. A direct lightning strike? Not so much. This brings us to the fundamental trade-off, the very heart of the decision between stocks and mutual funds. It's the eternal battle between risk and reward. With the single stock Synapse Robotics, you had the potential for an astronomical reward. If that robot had been real, your 10,000 could have become 100,000 or even a million. You can't get that kind of explosive, life-changing return from a diversified mutual fund. It's just not possible. The very thing that protects you from a stock like Synapse failing all those other companies also holds you back from capturing its meteoric rise. The winners in the fund are always diluted by the losers and the average performers. A mutual fund is designed to capture the average return of the market, not to hit a grand slam home run. So you have to ask yourself a deeply personal question. What kind of investor are you? Are you a treasure hunter willing to risk it all for a 1 in a million shot at a chest of gold? Knowing that most chests are empty? That's the individual stock picker. Or are you a farmer planting hundreds of seeds, knowing that some won't sprout, but confident that the overall harvest will be steady and reliable, feeding you for years to come? That's the mutual fund investor. There is no right answer, but for 99% of new investors, the answer should be obvious. The goal isn't to get rich quick. It's to build wealth for sure. The safety, the peace of mind, the built-in protection against a single company's disaster is what makes mutual funds the bedrock of most retirement plans. For 401(k)s and long-term savings goals, you are harnessing the collective power of the entire economy, rather than betting on the fragile fate of a single corporate entity. But this safety net, this incredible diversification that mutual funds offer, it doesn't come for free. There's a hidden cost, a silent fee that can eat away at your returns over decades without you even noticing. It's called the expense ratio. And understanding it is the difference between a comfortable retirement and working years longer than you ever planned. And that's exactly what we're going to break down next. So let's talk about this silent killer of wealth, the expense ratio. On the surface, it looks harmless. You'll see it listed as a small percentage, maybe 1%, 0.5%, or even 0.04%. And your brain, conditioned to think in big numbers, just brushes it off. 1%. What's 1%? If I make an 8% return and they take 1%, I still get 7%, right? That's still great. This is, without a doubt, one of the most expensive mistakes an investor can make. Because that tiny percentage isn't a one-time fee. It's a relentless annual charge on your entire investment balance. It's a parasite that feeds on your money every single day, year after year, whether the market goes up or down. It's the financial equivalent of trying to fill a bucket that has a small, constant leak. At first, you barely notice the water you're losing, but over 30 years, you realize half the water you poured in is gone. To really understand the devastating power of the expense ratio, let's leave the world of theory and tell a story. The story of two friends, Sarah and Tom. Both Sarah and Tom are 30 years old. They're diligent savers, and they each decide to invest a lump sum of $25,000 for their retirement, which is 35 years away. They don't plan to add another penny. They're just going to let this one investment grow. They both do their research, and for the sake of our story, they both manage to pick investments that generate the exact same average annual return before fees. A solid 8% per year. The only difference, the single variable in their financial futures, is the mutual fund they choose. Tom goes for a flashy, actively managed mutual fund. The marketing materials are slick, featuring a star fund manager who promises to use his expertise to beat the market. The fund has a track record that looks pretty good. For this expert management, the fund charges an expense ratio of 1.2%. Tom sees this number and thinks, that's the price of admission for getting a pro to handle my money. A little over 1% seems totally reasonable. Sarah, on the other hand, chooses a different path. She picks a simple, boring S&P 500 index fund. There's no star manager, no promise of beating the market. The fund's only goal is to mimic the performance of the 500 largest companies in the US. Because it's run by computers and requires very little human oversight, its expense ratio is incredibly low, just 0.04%. So we have Tom at 1.2% and Sarah at 0.04%. A difference of 1.16%. It seems insignificant. Now let's fast forward. After 1 year, their $25,000 investments both grew by 8%, which is $2,000. Their balances are now $27,000. Now the fees kick in. Tom's fund charges 1.2% of his entire $27,000 balance. That's $324. His net return isn't 8%. It's 6.8%. His final balance is $26,676. Sarah's fund charges 0.04% of her $27,000. That's a measly $10.80. Her net return is 7.96%. Her final balance is $26,989.20. After 1 year, the difference is about $313. Tom looks at this and shrugs. Big deal, he thinks. My expert manager is just getting warmed up. But the parasite is now attached. And it feeds on growth. Let's jump ahead 10 years. Assuming that 8% average annual return, Sarah's account, with its tiny 0.04% leak, has grown to about $53,840. Over that decade, she has paid a total of just over $400 in fees. Tom's account, with its larger 1.2% leak, has grown to only $48,950. The difference between them is now almost $5,000. But here's the truly terrifying part. Over that decade, Tom has paid nearly $4,500 in fees. You see what's happening? The gap between their account balances is larger than the total fees he paid. Why? Because every dollar that was taken from him in fees was a dollar that could no longer grow and compound for him. He didn't just lose the fee. He lost all the future growth that money would have generated for the next 25 years. This is the hidden brutal cost of high fees. It's a double whammy. Now let's go to the finish line. 35 years later, at age 65, they're ready to retire. They sit down to compare their final numbers from that single initial $25,000 investment. Sarah opens her statement. Her boring index fund, quietly chugging along and barely leaking, has grown to an incredible $368,000. Over 35 years, the total fees she paid amounted to less than $2,500. Tom takes a deep breath and opens his. His flashy, actively managed fund with its expert manager has grown to $255,000. Let that sink in. A $113,000 difference. From the exact same initial investment with the exact same market performance. Tom's small 1.2% fee didn't just cost him a little bit each year. It vaporized over $113,000 of his potential retirement money. That's a brand new car. It's a down payment on a house. It's years of travel. For many people, it's the difference between retiring at 65 and having to work until 70. And the total fees Tom paid? Over the 35 years, his fund skimmed over $46,000 directly from his account. That's nearly double his initial investment just gone. Poof. Paid to the fund company. The other $67,000 of the difference? That was the ghost of his money, the compound growth he never got to experience because the fees were taken out year after year. This is why the expense ratio is the most important number you should look at when choosing a mutual fund. It's a more reliable predictor of future returns than the fund's past performance, the manager's reputation, or the company's marketing budget. A high expense ratio is a guaranteed, permanent headwind blowing against your money for your entire investing life. A low expense ratio is a permanent tailwind at your back. And be warned, the expense ratio isn't the only potential fee. Some funds, especially those sold by commission-based financial advisors, have what are called loads. A front-end load is a sales charge you pay right when you buy the fund. You might invest $10,000, but a 5% front-end load means $500 is taken off the top immediately, and only $9,500 actually gets invested. A back-end load is a fee you pay when you sell. There are also 12B1 fees, which are hidden marketing fees, and other trading costs that can eat away at your returns. When you're looking at a fund, you need to look for a no-load fund with a rock-bottom expense ratio. Because these fees are the one thing in the investing world that you have almost total control over. You can't control what the stock market does tomorrow. You can't control interest rates or inflation. But you absolutely can control how much of your money you let a fund company take from you every single year. So if low cost is so obviously mathematically superior, why do these high-cost funds even exist? Why do millions of people, including our friend Tom, still pour their money into them? The answer lies in a single seductive promise. A promise of beating the market. And whether that promise is real, or just a very expensive illusion, is exactly what we're tackling next. This promise is the siren song of Wall Street, the core belief that drives not just the multi-trillion-dollar mutual fund industry, but also the dreams of every person who buys a single share of stock. It's the idea that you or someone you pay can be smarter than everyone else, that you can outwit the collective wisdom of millions of investors and achieve something greater than average. This is the world of active investing. When our friend Tom invests in his actively managed mutual fund, he isn't just buying a basket of stocks. He's hiring a gunslinger. He's paying for a star portfolio manager, a supposed genius with a team of analysts, who spends every waking moment trying to find the needle in the haystack. Their job is to analyze company balance sheets until their eyes bleed, to meet with CEOs, to predict economic trends, and to place strategic bets. They aim to buy stocks before they skyrocket and sell them before they crash. They are the captains of the ship, actively steering through the treacherous waters of the market, trying to find the shortcuts and favorable currents that the rest of the fleet will miss. The higher fee Tom pays? That's the captain's salary. He's paying for expertise, for the chance to outperform. This is the exact same dream that fuels the individual stock picker. It's the belief that you can find the next Amazon in a garage, the next Apple before the iPhone, the next Netflix when it was still mailing DVDs. It's a powerful, intoxicating idea, because it has happened. Consider Peter Lynch, the legendary manager of the Fidelity Magellan Fund. In the 1980s, his fund achieved returns that were simply biblical. And one of his most famous principles was to invest in what you know. The story goes that his wife, Carolyn, came home raving about a new pantyhose she bought at the grocery store called Legs. They came in a plastic egg, were high quality, and flew off the shelves. Lynch was intrigued. He did his research on the parent company, Hanes, and discovered a stock with incredible growth potential that Wall Street had completely overlooked. He invested heavily. The stock went up over 30 times. That single insight, born from a simple shopping trip, helped make his investors fortunes. That's the fantasy. Feels so attainable. You see a long line at a Chipotle, you love your new Peloton bike, you notice all your friends are suddenly using a new app. You think, this is it. This is my Legs moment. You're not just a passive participant anymore. You're an active player in the game. A detective looking for clues that everyone else is missing. You're not just trying to match the market, you're trying to conquer it. So we have the dream of the star fund manager and the dream of the brilliant individual stock picker. They are two sides of the same coin, both chasing outsized returns. But now we have to leave the dream behind and step into the cold, hard light of data. Because for the last few decades, a group called S&P Dow Jones Indices has been keeping score. They publish a report called the SPIVA Report, which stands for S&P Indices versus Active. And its findings are, well, they're brutal. The report does something very simple. It compares the performance of actively managed funds to their benchmark indexes, like the S&P 500. And here's what it consistently finds. In any single year, a little over half of all U.S. large-cap fund managers fail to beat the S&P 500. So right off the bat, it's a coin flip whether the expert you're paying is going to do better than a simple, cheap index fund. But it gets so much worse. When you look at a 5-year period, the number of active funds that underperform the index jumps to over 80%. Stretch it out to 10 years, and that number climbs to about 85%. And over a 15-year period, more than 92% of actively managed large-cap funds fail to beat the S&P 500. Let that sink in. Think about what that number actually means. It means if you pick 10 different highly paid professional fund managers, all of whom promise to beat the market, after 15 years on average 9 of them will have failed. 9 of them will have delivered a worse result than you could have gotten by buying a single low-cost S&P 500 index fund and literally going to sleep for a decade and a half. You have a greater than 90% chance of paying someone extra money for the privilege of underperforming. It's like hiring a personal trainer who makes you less fit. This isn't an opinion. It's a statistical reality. So the great question is why? Why is beating the market so impossibly hard, even for the supposed experts? The first reason is the most obvious: fees. Remember Tom's 1% expense ratio? That's a hurdle his fund manager has to clear every single year before he even starts. If the S&P 500 returns 10% in a year, a simple index fund gives you almost all of that 10%. But Tom's active fund manager doesn't just need to match that 10% return. He needs to get an 11% return just for Tom to break even with the index fund investor. He is starting the race a full percentage point behind the starting line, year after year after year. And that disadvantage compounds, becoming a massive anchor over time. The second reason is a bit more philosophical. The stock market is what economists call a highly efficient machine. Think of it like this. The price of a stock like Microsoft right now reflects the combined knowledge, research, and opinion of millions of the smartest analysts, hedge funds, and investors on the planet. They have already priced in everything that is publicly known, every earnings report, every new product announcement, every rumor about the competition. For a fund manager to consistently beat the market, they need to know something that all those other millions of people don't. Or they have to be consistently better at interpreting that information. It's like trying to be a professional poker player at a table where every single opponent can see your cards. You might win a hand through sheer luck, but over the long run, the market always wins. But the third reason is perhaps the most fascinating, and it gets to the very heart of how the stock market actually works. Most of us imagine the market as a collection of thousands of stocks, where some do well, some do poorly, and it all kind of averages out. But that's not what happens. Research by Professor Hendrik Bissembinder revealed a shocking truth. Over the last century, the vast majority of stocks, more than half, have delivered returns worse than one-month treasury bills. They were basically duds. The entire positive return of the US stock market has been generated by a tiny fraction, about 4%, of superstar companies. Mega winners like Apple, Microsoft, Amazon, and Nvidia. Now think about what this means for an active manager. An S&P 500 index fund, by its very nature, always owns these superstar stocks. It has to. It owns everything. But an active manager is making bets. They might decide that Apple is overvalued and sell it. They might miss the rise of Nvidia because they were focused on a different sector. If a fund manager misses just a handful of these crucial market-defining mega winners over their career, it becomes mathematically almost impossible for their other picks to make up the difference. They can be right on 50 other stocks, but missing that one rocket ship means they will inevitably fall behind the index that was guaranteed to be on board. So when you put it all together, the guaranteed drag of high fees, the incredible difficulty of outsmarting millions of other smart people, and the brutal fact that you have to pick from a tiny handful of true winners to succeed, the seductive promise of beating the market starts to look less like a sound strategy and more like a lottery ticket. This is the reality facing Tom and his expensive mutual fund. And it's the same monumental challenge facing anyone who thinks they can sit at their laptop and day trade their way to riches. The odds are not just against you. They are overwhelmingly, punishingly against you. So if trying to beat the market is a statistical loser's game for the vast majority of people, why does the entire industry, with its billions of dollars in advertising and Wall Street itself, push this narrative so hard? And more importantly, is there any situation where choosing an active fund or picking your own stocks actually makes sense? The answer might surprise you because it involves a fundamental misunderstanding of what risk really is. And that's where we're going next. Most investors, when they hear the word risk, think of one thing: volatility. They picture the stock market chart with its jagged red and green lines, plunging down and then soaring back up. And their goal, naturally, is to avoid the plunges. They want the upside without the downside. So they go looking for a smarter way. They hire an active fund manager or decide to pick their own stocks, believing that a clever human can see the storm clouds gathering and steer the ship to a safe harbor, selling before the crash and buying back in at the bottom. This is, without a doubt, the single biggest and most expensive misunderstanding in all of personal finance. Because volatility isn't the real risk. It's just the price of admission. It's the fee you pay for the wealth-building power of the stock market. The real risks, the ones that can permanently destroy your financial future, are far more sinister, and they are silent. The first silent killer is inflation risk, or what we should call purchasing power risk. This is the risk that your money, while sitting safely in a savings account, is secretly losing its value every single day. If your investments earn 2% a year, but inflation is running at 3%, you haven't made 2%. You've lost 1%. You are getting poorer. You can afford less this year than you could last year. An index fund, by capturing the growth of the entire economy, has historically been a phenomenal weapon against inflation. The S&P 500 has returned an average of about 10% per year over the long run. Even after accounting for inflation, that's a powerful wealth-generating return. The safe money in your bank account? It's a guaranteed loser against this risk. The second and most important silent killer is shortfall risk. This is the ultimate risk. This is the risk of simply not having enough money to live the life you want. It's the risk of reaching age 65 and realizing your nest egg won't cover your expenses, that you can't retire, that you can't support your family. Everything we do in investing is about defeating this one final boss. So let's re-examine our choice through this new lens. An S&P 500 index fund is a strategy designed to defeat these two real risks. It accepts the temporary emotional discomfort of volatility as a trade-off to crush inflation and give you the highest statistical probability of defeating shortfall risk over the long term. It does this by eliminating another huge risk we haven't even talked about yet: concentration risk. By owning 500 companies, you are protected if any one or even 10 of them go bankrupt. Your fortune isn't tied to the fate of a single CEO or a single product. The index just moves on, replacing the losers with the next winners automatically. Now look at active management. When you buy an actively managed mutual fund, or especially when you pick your own stocks, you are not reducing risk. You are fundamentally changing the type of risk you are taking on. You are willingly taking on massive concentration risk. Instead of betting on the collective ingenuity of the 500 largest American companies, you're betting on the stock-picking ability of one person or one small team. Or even worse, you're betting on yourself. You are swapping the manageable market-wide risk of volatility for the catastrophic individual risk of being flat-out wrong. And the data we've already seen proves that being wrong is the most likely outcome. So, when does it ever make sense to take this leap? When is it rational to abandon the safest, most reliable path for the one littered with failures? There are really only 2.5 scenarios where it's even logically debatable. The first scenario is when you're investing in what's called an inefficient market. The S&P 500 is considered a highly efficient market. What does that mean? It means there are hundreds of thousands of the world's smartest, most well-paid analysts, traders, and algorithms watching every single move these companies make. The second, Apple announces a new iPhone. That information is instantly priced into the stock. There's no secret information left to find. Trying to find an edge here is like trying to find a $20 bill on the floor of Grand Central Station during rush hour. If it were there, someone would have already picked it up. But what about other markets? What about a tiny emerging market in Southeast Asia? Or a niche industry of small-cap biotech firms working on obscure gene-editing therapies? These markets might be inefficient. There are fewer analysts watching them. Information is harder to come by. In these specific murky ponds, a truly skilled fund manager who specializes, who flies there, who meets the management teams, who understands the local culture and regulations, might be able to gain a genuine informational advantage. They might actually know something the rest of the market doesn't. This is the classic argument for active management in areas like small cap or international stocks. The evidence is still shaky, but the logic is at least sound. The second scenario is when you personally possess a genuine world-class verifiable edge. And I need you to be brutally honest with yourself here. This does not mean you read a lot of articles online. It does not mean you have a good feeling about a new technology. It means you have asymmetric information or a truly superior analytical framework. Are you a leading semiconductor engineer who understands a new chip patent in a way that a Wall Street analyst with a finance degree simply cannot? Are you a logistics expert who can see supply chain efficiencies in a company like Amazon that are invisible to the public? This is the Peter Lynch model. Lynch was the legendary manager of the Magellan Fund at Fidelity, one of an exceedingly small number of active managers to consistently beat the market for a long period. His philosophy was to invest in what you know. But he didn't mean just buying stock in the coffee shop you like. He meant leveraging your professional, on-the-ground expertise. If you are a doctor and you see all of your colleagues suddenly prescribing a new drug from one specific company because it's a game changer, that's an edge. That's information the market might not have fully priced in yet. For 99.9% of the population, this does not apply. And confusing your hobby or your interest with professional-grade expertise is the fast track to financial ruin. And the half scenario? It's when your goal is so specific that a passive index fund simply doesn't exist for it. For example, maybe you want to invest exclusively in companies dedicated to clean water technology, and you want to exclude any company with a poor environmental record. You might need an active manager to build that very specific custom portfolio for you. You're not necessarily doing it to beat the market, but to align your investments with your values. You're optimizing for something other than pure return, which is a perfectly valid choice. So what's the takeaway? The decision to go active isn't a defensive one, it's an offensive one. You aren't doing it to find safety. You are doing it to take on more risk, specifically more concentration risk, in the calculated hope of achieving extraordinary market-beating returns. You are leaving the wide, paved, well-lit highway of the S&P 500 and venturing onto a dark, unpaved road because you believe you have a special map that shows a shortcut to treasure. For nearly everyone, this is a terrible idea, because we don't have a special map. We just have hubris. We have a story our buddy told us about a stock that went to the moon. We confuse a lucky roll of the dice in a bull market with skill. We suffer from the Dunning-Kruger effect, where our lack of knowledge makes us overconfident in our own abilities. The discipline of passive investing is accepting a profound and humbling truth. You are not special. I am not special. We are not smarter than the collective wisdom of the entire market. And by accepting that, we unlock the market's full power to work for us, instead of fighting against it. We choose the path with the highest probability of success, even if it's not the most exciting story to tell at a cocktail party. So, if we accept this, if we agree that for the vast majority of our money, a passive index-based approach is the most rational path, the next question becomes which index? We've been using the S&P 500 as our primary example, but is that really the best choice? What about a total stock market index fund? Or what about the rest of the world? Shouldn't we own international stocks too? Building that simple yet powerful core portfolio is the crucial next step. So let's tackle that question head-on. You've decided on an index fund. You walk into the metaphorical investing supermarket, and right at the front, there's this giant flashy display for the S&P 500 index fund. It's the brand name everyone knows. It's the one you hear about on the news every single night. The market was up today, they say, and 99% of the time they're talking about the S&P 500. It tracks the 500 largest, most dominant companies in America. Apple, Microsoft, Amazon, Google. It's a powerhouse. Investing in this one fund feels safe, smart, and profoundly American. And for decades, it has been an incredible wealth-building machine. Buying an S&P 500 index fund is a fantastic decision compared to doing nothing, or compared to trying to pick individual stocks. It's a B+ or even an A- grade move. But the question we have to ask is, can we do better? Is tracking only the 500 biggest players the optimal strategy? Think about it. The United States economy isn't just 500 companies. As of today, there are over 4,000 publicly traded companies in the US. By investing only in the S&P 500, you are intentionally ignoring thousands of other businesses. You're missing out on the medium-sized companies, the mid-caps that are agile and growing fast, potentially the giants of tomorrow. You're also missing out on the small-sized companies, the small caps, the hungry innovators and disruptive startups that could deliver explosive growth. Historically, over very long periods, smaller companies have often provided higher returns than large companies to compensate for their higher risk. By excluding them, you're essentially betting that the current champions will always be the champions. You're betting on the varsity team, but ignoring the junior varsity team that has the next superstar quarterback just waiting for their shot. This is where the total stock market index fund comes in. It doesn't just buy the 500 biggest companies. It aims to buy all of them. Every publicly traded US stock, from the behemoth that is Apple all the way down to the tiniest, most obscure company you've never heard of. It's the ultimate expression of don't look for the needle in the haystack, just buy the whole haystack. Now, because these funds are market cap weighted, the big companies like Apple and Microsoft still make up the largest portion of the fund. It's not like the tiniest company has the same influence, but you still own a small proportionate slice of those thousands of smaller companies. You are fully, completely diversified across the entire US economy. You're not just betting on the current winners, you're betting on America, period. You own the established giants, the rising stars, and the next generation innovators all in one simple low-cost fund. For most people, a total stock market index fund is a more diversified, and therefore arguably superior, core holding than an S&P 500 fund. It's the A+ move for your US stock allocation. But hold on, we've just spent all this time perfectly diversifying across the entire United States. But what about the other 96% of the world's population? What about the other half of the global stock market? This brings us to one of the biggest, most common, and most dangerous mistakes that new investors make: home country bias. Home country bias is the natural human tendency to invest overwhelmingly in the country where you live. It makes sense on the surface. We see American brands every day. We read about the US economy. Feels familiar. Feels safe. The US has been the undisputed world economic leader for a century. So we load up on US stocks thinking we're set. Many American investors have 90 or even 100% of their stock portfolio in US companies. But this is a massive uncompensated risk. Let me take you back in time. Imagine it's the year 2000. The dot-com bubble is in full swing. US tech stocks are soaring to unbelievable heights. The US economy feels absolutely invincible. If you had suggested to an American investor back then that they should sell some of their high-flying US stocks and buy companies in Europe or Japan or emerging markets, they would have laughed you out of the room. Why would anyone do that? America was the only game in town. Well, here's what happened next. From the start of 2000 to the end of 2009, the S&P 500, including dividends, produced a total return of -9%. A whole decade of investing in the biggest US companies, and you would have lost money. It's now famously known as the lost decade for US stocks. But you know what didn't have a lost decade? International stocks. During that same 10-year period, international developed market stocks were up over 15%, and emerging market stocks were up over 150%. The people who were globally diversified did just fine. The people who suffered from extreme home country bias got crushed. This isn't a one-time fluke. History is filled with these long periods of role reversal. In the 1970s, US stocks went nowhere while international stocks soared. In the 1980s, Japan was the world's dominant market, and US stocks were an afterthought. The 2010s were a fantastic decade for the US, which has led many of us to forget the painful lessons of the 2000s. But the pendulum always swings back. Think of it this way. The United States economy makes up roughly 25% of the global economy, but the US stock market makes up a little over 50% of the world's total stock market value. By investing only in the US, you are ignoring nearly half of the world's investment opportunities. You're ignoring world-class companies like Samsung in South Korea, Toyota in Japan, LVMH in France, or Nestle in Switzerland. These are global titans of industry. Why would you not want to own a piece of their success? Not diversifying globally is like being a sports fan who only watches the NFL. You're missing out on the incredible talent in the NBA, Major League Baseball, and international soccer. You might have a favorite league, but you'd be foolish to think all the best athletes in the world only play American football. The solution, thankfully, is just as simple as buying a total US stock market fund. You can buy a total international stock market index fund. This one fund buys you a piece of thousands of companies across all the developed and emerging economies of the world, outside of the US. It gives you exposure to Europe, Japan, Australia, Canada, China, India, Brazil, and so on. So now we have the two core building blocks for a truly powerful, globally diversified stock portfolio. Block 1. A total US stock market index fund. Block 2. A total international stock market index fund. With just these two funds, you can own a piece of nearly every publicly traded company on planet Earth. You are diversified across geographies, economies, currencies, and political systems. If the US economy hits a rough patch for a few years, your international holdings can help cushion the blow. If a new technology boom happens in Southeast Asia, you'll be a part of it. You are no longer making a bet on a single country's success. You are making a bet on global human ingenuity and economic progress as a whole. That is a much safer and much smarter bet to make. So how do you split your money between these two funds? There's no single correct answer, but a very common and sensible starting point is to approximate the global market weight. Right now, as we said, the US makes up a bit over half of the world's stock market value. So a portfolio that is 60% US stocks and 40% international stocks is a fantastic, balanced, and widely recommended allocation. Some people prefer 70/30ths, some 50/50ths. The exact number is less important than the principle of being meaningfully diversified outside your home country. Okay, this is huge. We've gone from picking single stocks to buying a fund. We've gone from a US-only S&P 500 fund to a more comprehensive total US market fund. And now we've added a total international market fund to be truly, globally diversified. We have built the growth engine of our financial future. This two-fund stock portfolio is simple, it's powerful, and it's built to weather almost any economic storm over the long run. But we're missing one final, crucial piece of the puzzle. Everything we've talked about, US stocks, international stocks, is designed for growth. But what about stability? What about defense? Stocks are volatile. They go up, but they also go down, sometimes violently. Building a portfolio with only stocks is like building a race car that's all engine and no brakes. It's thrilling when the road is straight, but terrifying and potentially disastrous when you hit a sharp curve. We need to install the brakes. We need an asset that zigs when stocks zag, an anchor to windward that provides stability and reduces the terrifying plunges during a market crash. That anchor has a name. It's called a bond. and understanding the role that bonds play, and how to add them to our stock portfolio to create a truly balanced allocation for any age or risk tolerance, well, that is the final master key to building a portfolio that you can stick with for a lifetime. So, what is this master key? It's an asset class that most new investors either completely ignore or completely misunderstand. It's not as exciting as a high-flying tech stock. It won't make you rich overnight, but it will, quite literally, save your portfolio from ruin during a crisis. We're talking about bonds, and I know what you're thinking. Bonds? Isn't that what my grandparents invest in? Isn't that boring? Yes, and that boredom is their superpower. Think of it this way. A stock makes you an owner of a company. A bond makes you a lender. When you buy a bond, you are essentially loaning money to an entity, either a corporation or a government. In return for your loan, they promise to pay you back the full amount, known as the principal, on a specific date in the future. And along the way, they pay you regular interest payments, kind of like a salary for letting them use your money. It's a formal IOU. You're not betting on the company's explosive growth. You're betting on its ability to simply pay its bills. That's a fundamentally different and safer bet. Now, why is this so critical for your portfolio? Because stocks and high-quality bonds have a special, almost magical relationship. They tend to move in opposite directions, especially during times of panic. Let's paint a picture. It's 2008. The financial world is collapsing. The stock market is in a free fall. Day after day, you log into your account and see nothing but a sea of red. Your $100,000 portfolio is now worth $70,000, then $60,000. Your stomach is in knots. The news is screaming about recession and collapse. Every instinct in your body is telling you to sell everything before it goes to zero. This is the moment where most investors fail. They panic sell at the absolute bottom, locking in their losses forever. But imagine you had a balanced portfolio. Imagine 30% of your money was in high-quality government bonds. While your stocks are plummeting, something incredible is happening. Scared investors are pulling their money out of the risky stock market and desperately searching for a safe place to put it. And what's the safest financial instrument on planet Earth? A bond backed by the full faith and credit of the United States government. So all that panic money floods into U.S. Treasury bonds. A flood of demand causes the price of those bonds to go up. So while the stock portion of your portfolio is down 30 or 40%, the bond portion is actually up 5 or 10%. It acts as a shock absorber, a cushion that softens the brutal blow of a market crash. It's the financial equivalent of a seatbelt in a car crash. It doesn't prevent the crash, but it dramatically increases your odds of surviving it. That stability is what gives you the psychological fortitude to not sell. It's what allows you to stay in the game long enough for the stocks to inevitably recover and march to new highs. Without bonds, you're just riding the roller coaster without a safety harness. Now, not all bonds are created equal. The two main categories you need to know are government bonds and corporate bonds. Government bonds, specifically U.S. Treasury bonds, are the gold standard of safety. The risk of the U.S. government defaulting on its debt is considered to be virtually zero. Corporate bonds, on the other hand, are loans to companies from giants like Apple and Microsoft to smaller, riskier businesses. Here you have to consider credit risk. Just like a person has a credit score, companies are rated by agencies on their financial health. A highly rated company like Apple is very likely to pay you back, so they offer a lower interest rate. A struggling company might have to offer a much higher interest rate to entice you to take on the risk that they might go bankrupt and not pay you back at all. For most new investors building a core portfolio, U.S. government bonds are the primary tool for stability. Okay, so how do we actually buy them? Just like with stocks, you could go out and buy individual bonds, but it's complex and requires a lot of capital. The far better solution, once again, is a mutual fund or an ETF. You can buy a total bond market index fund, which instantly gives you a diversified portfolio of thousands of U.S. government and high-quality corporate bonds, all in one neat package. It's the easy button for adding that crucial stability to your portfolio. This brings us to the most important question of all. How do you combine stocks and bonds? What's the right mix? This is called your asset allocation, and it's the single most important investment decision you will ever make. It has more impact on your long-term returns than any individual stock or fund you could ever pick. The right mix depends almost entirely on two things: your time horizon and your risk tolerance. How long until you need the money, and how much volatility can your stomach handle? A great starting point for figuring this out is a simple rule of thumb called 110 minus your age. You take the number 110, subtract your current age, and that's the percentage you should consider putting in stocks. The rest goes into bonds. Let's see how this works. If you're a 25-year-old just starting your career, you have a massive 40-year time horizon until retirement. 110 minus 25 is 85. So a portfolio of 85% stocks and 15% bonds could be a great fit. This is an aggressive, growth-oriented portfolio. You can afford to take on the volatility of the stock market because you have decades to recover from any downturns. Now let's say you're 45 years old. You're in your peak earning years, and retirement is now on the horizon. 110 minus 45 is 65. A 65% stock, 35% bond portfolio is more moderate. You still want growth, but you're introducing a much larger bond cushion to protect the wealth you've already built. A 30 or 40% drop in the market would still hurt, but it wouldn't be as catastrophic. Finally, imagine you're 65 and about to retire. 110 minus 65 is 45. A portfolio of 45% stocks and 55% bonds is a conservative, wealth preservation portfolio. Your primary goal is no longer growth. It's protecting your nest egg and generating steady income from your bond interest payments to live on. You can't afford a massive drawdown right when you need to start withdrawing money. This simple formula is just a guideline, but it beautifully illustrates the core concept. As you get older and closer to your financial goal, you should gradually shift your allocation from being stock-heavy to being more bond-heavy, trading potential growth for stability. But there's one last piece to this puzzle, a professional-level technique that automates good investor behavior. It's called rebalancing. Let's go back to our 25-year-old with an 85-15 portfolio. Imagine the stock market has a fantastic year and a huge run-up. At the end of the year, because the stocks grew so much faster than the bonds, the portfolio might now be 90% stocks and 10% bonds. It's drifted away from the target. Rebalancing is the simple act of selling off some of the asset that performed well and using the proceeds to buy more of the asset that underperformed, bringing you back to your target 85-15 split. In this case, you'd sell 5% of your stocks and buy 5% more bonds. This might feel counterintuitive. Why would you sell your winners and buy your losers? Because it forces you systematically and without emotion to do the one thing every investor dreams of: sell high and buy low. When stocks are expensive, you're automatically trimming your position. When stocks crash and are on sale, your rebalancing process will force you to sell your stable bonds to buy more stocks at a discount. It's a disciplined, automatic strategy that removes fear and greed from the equation, ensuring your portfolio's risk level always stays exactly where you want it to be. This partnership between stocks and bonds is the foundation of every successful, long-term investment strategy on Earth. Stocks are the engine of growth. They provide the horsepower that drives your wealth forward over decades. Bonds are the brakes and the suspension. They provide the stability and control that keep you on the road during the inevitable storms, ensuring you actually reach your destination. We've now covered everything from the fundamental differences between stocks and funds, to diversification, to asset allocation. We've designed the perfect investment vehicle. We know what it's made of and why. We understand the rules of the road. There's just one thing left to do. It's time to finally put the key in the ignition. And turning that key is simpler than you've been led to believe. It starts with choosing where to park your car, your investment vehicle. This is called a brokerage. Think of it as a specialized bank account for your investments. You've heard the names Fidelity, Vanguard, Charles Schwab. These are the major highways of the investment world, trusted by millions. Opening an account is now a process you can do online in about 15 minutes. You'll provide your personal information, link your bank account, and just like that, you're no longer a spectator. You're in the driver's seat. Once your account is funded, you're ready to buy. And this is where the practical difference between a stock and a mutual fund becomes crystal clear. If you want to buy a share of, say, Apple, you'll use its ticker symbol, a unique code of letters. For Apple, it's Apple. You type it in, see the price fluctuating second by second, and decide how many shares you want to buy. You can place a market order, which means you buy immediately at the current best price, or a limit order, where you set a specific price you're willing to pay. It's direct, it's immediate, and you are in total control of the transaction. You are buying a specific part of a specific company at a specific moment in time. Now, let's say you want to buy that S&P 500 index fund we talked about. It also has a ticker symbol, but it's often 5 letters, frequently ending in X. When you go to buy it, you'll notice something different. There's no price bouncing around all day. Instead, you decide how many dollars you want to invest. You put in your order for, say, $500. Your order sits there waiting with all the other orders for that day. Then, after the market closes, the fund calculates its final price for the day, called the net asset value, or NAV. Your $500 is then used to buy shares at that one single end-of-day price. You're not trying to time the market by the second. You're simply buying into the entire basket of assets at a fair collective price. This is a fundamental design difference. Stocks trade with urgency and precision. Mutual funds trade with patience and aggregation. So we've come full circle. We've built our understanding from the ground up. And now, standing at this fork in the road, the choice seems clearer than ever. The path of individual stocks is the path of the active participant. It's for the person who wants their hands on the wheel, who enjoys the research, who has a genuine belief in the future of a specific company. You're not just buying a ticker symbol. You're buying a piece of a business. You're betting on its leadership, its innovation, its ability to outmaneuver the competition. The potential for incredible returns is there, but so is the risk of a total stall. It requires conviction, a strong stomach for volatility, and the discipline to not panic sell when the road gets bumpy. It is the path of high engagement, high risk, and high potential reward. The path of mutual funds is the path of the strategic delegator. It's for the person who understands the power of the market as a whole, but doesn't have the time or desire to analyze individual balance sheets. You're not betting on a single company. You're betting on an entire economy, an entire sector, or the expertise of a professional manager. You're accepting that you'll never get the explosive 1,000% gain from a single breakout stock, but you're also shielding yourself from the catastrophic 90% loss if that same stock fails. It's the path of diversification, of consistency, of harnessing the broad currents of the market, rather than trying to catch lightning in a bottle. It is the path of lower individual company risk, built-in management, and steady systematic growth. But here is the single most important secret that experienced investors know, the one that this entire debate often misses. It's not a permanent one or the other choice. It's not a tattoo. It's a strategy. And the best strategy for most people is often a hybrid. Think of it like this: your core investment, the engine of your long-term wealth, could be built on a foundation of low-cost, diversified mutual funds or ETFs. This is your reliable family sedan. It's safe, it's efficient, and its job is to get you to your destination, retirement, financial freedom, without any drama. This is the 80 or 90% of your portfolio that you contribute to regularly and let the power of the market do the heavy lifting. But maybe you have a passion for technology. Maybe you truly believe in a new green energy company. With the remaining 10 or 20% of your portfolio, you can buy a few individual stocks. This is your weekend sports car. It's fun, it's exciting, and it gives you a chance to experience those thrilling accelerations. If one of those stocks does incredibly well, fantastic. If one of them fails, it's disappointing, but it doesn't wreck your entire financial plan because your reliable sedan is still cruising along safe and sound. This approach gives you the best of both worlds: the stability of diversification and the excitement of individual ownership. Yet, after all this discussion, after all the talk of risk, diversification, fees, and strategy, none of it, not a single word, points to the most powerful factor in your investment success. It's not about choosing the perfect stock. It's not about finding the perfect fund. The single greatest force in your financial universe is time. It's a force called compounding. Albert Einstein supposedly called it the eighth wonder of the world. And it works like this: you invest your money and it earns a return. The next year, you earn a return not just on your original money, but also on the returns from the first year. Your money starts making money, and then your money's money starts making money. It creates a snowball effect that, over decades, is so powerful it borders on magic. Let me give you a quick, powerful example. Meet two friends, Sarah and Ben. Sarah starts investing at age 25. She invests just $200 a month. She does this for 10 years and then stops completely. She never invests another penny. By age 35, she has invested a total of $24,000. Her friend Ben, he waits. He starts at age 35, the exact same age Sarah stopped. Ben is more disciplined. He invests $200 a month not for 10 years, but for 30 years, all the way until he's 65. He invests a total of $72,000, 3 times more than Sarah. Now, who has more money at age 65? Assuming they both earned a standard 8% average annual return. It's not even close. Sarah, who started early and invested less, ends up with over $600,000. Ben, who started later and invested far more, ends up with around $300,000. Sarah has double the money, despite investing a third of the amount. Why? Because her money had an extra 10 years to work for her. An extra decade for the snowball to roll and grow. That is the power you have right now. The real risk is not picking a stock that goes down. The real risk is not choosing a mutual fund that underperforms the market for a year. The single greatest risk in your financial life is procrastination. It is the "I'll do it next year" that costs you not thousands but potentially hundreds of thousands of dollars. The purpose of this journey we've been on together was not to tell you what to buy. It was to demystify the process, to tear down the wall of confusing jargon and show you that the concepts behind investing are simple, intuitive, and accessible to everyone. You now know what a stock is. You know what a mutual fund is. You understand diversification, risk, and the incredible power of time. You are no longer on the outside looking in. You have the knowledge. You have the map. The financial world wants you to think this is complicated, that you need some kind of secret knowledge. But you don't. You just need to start. The journey from being someone who wants to invest to being an investor is bridged by a single action. The ancient proverb says the best time to plant a tree was 20 years ago. The second best time is right now. Your future self is counting on the decisions you make today. The vehicle is ready. The road is clear. The key is in your hand. The only question left is, are you ready to turn it?